Good morning, I guess I should say. So this is SoFi's Q3 earnings. So they did come out. Going to go through that. Obviously, they do start off in roughly about 30 minutes. There's going to be hopefully a lot of good things that is also said as far as the X factor. But generally, just looking at the earnings, they were very good. And so this is after hours or pre-market activity, and it is going up. So welcome back to the $6 range, ladies and gentlemen. Currently up 14.89%. So as we've been saying for the longest time, this has been a no-brainer, and the stats, once again, prove it. So I'm going to go through all that fun jazz. Make sure you guys hit that thumbs up. If you are rewatching this for the first time, I'm going to have chapters at the bottom so you can skip right to the earnings, and that way you don't have to listen to me talk. But if you do, stay tuned. So, yeah, pretty good results if you ask me. So overall, customer growth, like I said in a lot of videos, I think that's a lot of the biggest factor of them all. Customer growth, it will lead to product growth and deposits, everything. So customer growth did go up. It looks like new members added nearly 61%. 61% year over year, whereas in Q2 they raised it 69%, I believe. But still, 61%, that's very, very impressive And we also have to take a step back. So whatever they do say in this earnings, you have to realize that this was very fearful. Q3, like they were impending and assuming a massive recession was underway. So kind of have to take a lot of that with a grain of salt. But so yeah, 51%, that's pretty good. Record adjusted EBITDA, 44 million, up 332%. So that's huge. Product growth, 69%. Previously, I believe that was 79%, but still, like I said, it all comes down to and boils down to customer growth. And on that front as well, we did do a hell of a lot of good campaigns. And looking here, during that time period, we raised the interest rates were raised roughly about 1.5% in Q3. So that's usually very beneficial for SoFi's bottom line, or any banking sector if you want to talk about that. So I guess I just should start off by saying I appreciate you guys all hopping on. I know it is very early. This is the earliest live stream I particularly have ever done. So I did fully honest, just looked at a lot of these just roughly. I still project easily that we should justifiably be around the 850 range. So that's my interpretation of how I see things. My estimate based on this earnings, I'm going to continue to go through that, but I personally feel we could easily get to around just shy of around 7 today. That's my estimate, just so I'm not a financial advisor though, but I don't know. There's a lot of strong resistance at that $7 range, so I don't know if we necessarily have a lot, but I think this is a very good realization that we have a very good diamond in the rough. So here is the presentation. So Q3 2022 summary results. Fun old disclaimer. Member growth, 61%. I guess I should just went on here rather than this small screen, but 61%, very, very exciting stuff. 69% the previous. So clearly we have a very good asset on our hands, and I believe as well on the 5th, they recently announced that they're going to be raising the APY to 3%. At some stage in the game, SoFi is going to have to transition away from incentivizing customers to come to now prioritizing revenue, but that will be most likely in the next couple of quarters. Products, 69%, so that is a little bit lower. Funny thing is, what I don't like about investing is, yes, 69% is very impressive, and that is definitely very good. But there's going to be a lot of analysts that do see a trend saying that it's going down. And this is what happens, is just, it sucks, is people try to point out a negative. And in reality, a lot of these same analysts are really, a lot of their institutions are competing with SoFi. So it really sucks in the grand scheme of things, especially more so when we got our chartered, being a chartered bank. Bank of America just comes and gives us a negative rating. It just sucks sometimes. But Galileo accounts 40%. And I think that's fairly good. As far as I knew, they didn't really have any big operations that was kind of underway. So 40% is pretty good. Lending. So this is one attribute that I think a lot of analysts, when they did give ratings on SoFi leading up to the earnings, I believe the latest one was October the 20th, I believe. But I think a lot of analysts are now going to be kind of ripping all of this information apart. Lending. More so based on the Q2 earnings, a lot of the common questions coming from analysts was the fact that what are you doing to mitigate risk? What are you doing to prevent a recession of sorts, if you want to call it that? So just my prediction, they are going to do the exact same thing, probably a little bit more aggressively this time around. But they're going to be looking at all the lending services. And it does look like, despite it only being 83% for financial service products up, most likely they're going to take that and say, well, you guys are taking on more risk. It's not really justifiable or right, but once again, that's the fun part of investing. No matter what, you do see a common trend with all of SoFi so far. Everything is up. Everything. And that is, I think, the more important takeaway coming from an investor. And like I always say, I've been investing since 2009. When you do find a good company, these are the type of charts that you want to find. And we were and you wouldn't even estimate or guess that we were in a bear market, and I guess still are in a bear market, but you wouldn't guess that based on all of these charts. But so financial service productivity loop. So it looks like total Q3 4.2 million. Invest, money, relay, credit card, personal line, home. Let's see, what was this? Q3, Q1, 2021. So 21. So home did go up a little bit. Personal loans went up a ton. So that's pretty. This is a comparison between 2021 and 2022. It nearly doubled. So that's pretty impressive. Invest, we nearly got twice as much as far as financial services for the productivity. So clearly a lot more people are using Invest. And going back to that point, hopefully they do actually talk about options activity. It's really not a known fact, but options activity is, oddly enough, the more used product or aspect of investing, and also it's the most profitable for brokers and obviously banks. So I think this is why a lot of people don't seem to understand why so many people have been saying, whether it be on Twitter or whatever, when are you doing options? Like, why? Like, I want options. Because that should give SoFi a pretty good fundamental base for this. So hopefully this invest aspect is going to continue to grow, but this is pretty impressive just based on 2021 to 2022. Money, relay. So just continuing on. So quarterly performance, net revenue, 4.19 or 419, not 4 point, but 419. That's pretty good. Estimate was 392 million. So this is a very big beat in that regard. And I believe this is higher than any estimate that I did see. And funny enough, though, like I already been saying in videos, our actual revenue is always sufficiently higher than analysts. So that's a very positive thing. Quarterly adjusted EBITDA, 44 million. So definitely blowing previous quarters out of the water. Very, very profitable. And actually, I think I'll get to that near the end, but I want to see how much cash we have in debt and all that. But annual adjusted net revenue, so 1.3 or 1.3 billion. And let's see. They raised guidance as well. Annual growth projected, so they raised a couple percent. That's pretty good. Whether that's so, them raising guidance for the tail end for clearly Q4, I would assume it is because of and the recent acquisition with them, but I could be wrong. There's a lot of acquisitions that did occur over the last maybe about 3 weeks, and all of which could have added to this kind of adjustment here. So no matter what, though, that's good. Let's see. Okay, so student loan, let's see, home loans. I think I'm focusing on the home loans because a lot of analysts, when they, like I said, they're going to tear it all apart. Initially, they're going to look at home loans because I think that's what is going to be the bubble popping per se, is going to be the homes or the mortgages and so forth. So let's see, mortgages, it did go up around 30%, give or take. And just so you guys know, during the actual live conference, I'm going to shut up. I'm not going to say anything. You guys are just going to listen. You guys don't need to hear me. Afterwards, though, this is where I'm going to chime in and go over that. And it looks like in around 4 minutes, we can actually officially log in. Lending products overall up. Let's see what student loans did go down. Oh, sorry, that's okay. No, that went up. Let's see. Student loans 2021, 2022, Q3. Okay, so it went up a little bit. My apologies, I was looking at the wrong column. It is early. Like I said, this is the earliest live stream I've ever done. You know what? So actually looking at the correct column, our home loans did go down. So that could be a positive if you want to spin it like that. Of course, I think, like I always say, there's different ways to interpret things. And when you are having someone that's trying to purposefully tear apart earnings, they could use this same number about the home loans, convert it to a positive and a negative. Well, they could say, well, home loans are down. That's people, you aren't driving demand. So that could be seen as that way. Or like I said, if it goes up, you're having too much risk. But still, personal loans up, I think that's fairly good, especially more so. I think we're very stringent on how we are selecting customers, so our quality customers that we are offering credit to is definitely going up. Student loans is up, and that's going to kick off January the 1st as well, so win-win for us. But let's get right to the nitty-gritty as far as how much cash they have. Okay, I'm just going to zoom back out. Okay, so assets in thousands, cash equivalents, restricted cash, student loans. Okay, so total assets, that's pretty good. And this is just, okay. Revolving credit facility. So they did, okay, so the revolving credit facility, it looks like they did use some in Q3. So 486,000. Cash and cash equivalents 935 in Q3. Restricted student loans, home loans. Okay, let's see. Commercial credit cards 188. I believe it was around 140 last quarter, so that's definitely a very positive thing to see credit cards go up. Because of course with credit cards, obviously it's a completely different ball game from mortgages. It's definitely on the downside, and based on the latest news as well, they've really done a lot of things to prevent fraud on credit cards, which when there is fraud, the banks eat completely the whole fee. So they're definitely doing what they can to reduce their their risk. And I think that's one thing I've really been stressing over the last couple of videos, or over the last little bit, is SoFi is trying to do mitigate a lot of risk. And so this is where you're going to get a lot of analysts kind of saying the opposite end of that. I'm just going to sign in for one moment, and then we can get back to it. Almost finished going through the presentation though. In case you guys haven't participated in a SoFi earnings before, this is a long one. And yeah, it is a very long one to be, yeah, it's fun. Mostly though, like I said, because of analyst rating. So I guess can't really complain that much, because us being desirable, why are we going to argue with that? Goodwill up quite a lot, so that was anticipated. Deposits, ooh, that's pretty impressive. 5 million for deposits. And that is, I believe, even the estimates were around 4. So actually, I'm just going to pop over. Let's see what we're at right now. So after hours, or pre-market, $6.15. So we did, I believe, when I started the live stream, around 14.98% up. But keep in mind, pre-market, after hours are all very, very volatile. Yeah, 𝗪𝗧𝗪, I completely agree. They beat on all, raised guidance, and this is a bear market. Rain, the live conference starts in around 13 minutes. So this time you guys are just hearing me rant, going over some technicals and so forth. Because like I said, even if you take a step back, SoFi, or just generally, the interest rates went up roughly about 1.5% in the Q3. So if you do couple that with all the other facts behind it, like, this is a very, very impressive time. And the fact that they might be raising rates, I think it's estimated clearly 75 basis points tomorrow. It's a win-win, guys. So yeah, like I said, when it comes down to earnings, there's several different things we care about: earnings per share, revenue, future guidance. And in that future guidance, that's that X factor that we all care about. That encompasses a lot of things, what they're going to be doing in the future. That is more so what they're going to be talking on in this actual conference as well, because they don't say that on the actual document here. But all the actual numbers, as far as customer growth, that went up 61%, product growth went up 69%, deposits went up massively. So all the, basically the numbers and ratios that we care about for the base underlying business all went up. I've never actually read a lot of this footnote stuff. We define a member as someone who has a lending relationship with us through organization and or servicing. They even define that. So yeah. And then once again, if you guys are just tuning in, I am going to be muting myself. You guys don't need to hear me at all during the live stream. You just listen to Anthony, and whether it be Chris or someone else, we'll see. But yeah, as I think a lot of us have known, is this was going to be a home run earnings. And I'm always a big believer. So the way I see SoFi, just fundamentally, I feel us is a David versus Goliath kind of situation. We are going up against a lot of the big traditional banks who have, and in their cases, like, they don't have to offer the 3% APY to people. They don't care. They're just collecting revenue. We're on an interesting kind of growth aspect that we have to offer the 3% to incentivize customers to come over. When it comes down to the point when SoFi is going to transition away from that to start focusing a little bit more on revenue, that is when, my friends, the stock price is going to go just up, 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 up. And that is going to be all this patience. I know we've gone down quite a lot over the last little bit. Been a very volatile ride, but trust me, when they do start transitioning away from that, this is when they are going, all of our patience and craziness has been going on in the market. That is when it's going to be come into realization. My own interpretation, at least, on that, but that's usually what does happen. So even though it is very exciting for this to all go up and so forth, it's all just small relative stuff. But clearly pre-market though, if you guys you like to see it go up generally, today is the day. So welcome back to the $6 range, ladies and gentlemen. Hopefully we could probably get to around the $7 range most likely today if we do get enough momentum. And also it is helping us, as you can see, all these indexes are kind of going. They're all for the most part very much up. S&P 500 up 1%, NASDAQ 100 up 1.2%. So I think right now this is a perfect day. And I absolutely hate when this happens, when a company that I invest in has good news, but it's a very much red day. So it just gets kind of brushed under the rug. But guys, this is probably one of the best scenarios that we could get. We have a massive home run earnings and a very green day. This is a recipe for a very big increase. And for those of you that do believe in potentially a squeeze, we do have, as far as short interest, roughly about 12.45% for short interest, 97.4 million shares being shorted. So potentially a lot of those could close them out. And this is all the dark pool transactions. As you can see, this was more so from yesterday. None have started today, at least. But things are looking up, guys. In case you guys are just tuning in, I'll just give you the quick summary. As far as member growth, 61% year over year. Very, very positive, very beautiful trend going on here. Product growth, new product, I should say, 69%. So once again, another beautiful chart. Previous was 79%. Galileo accounts, 40%. Lending and financial services, all very much up. The housing, our home loans, was down a little bit, so that could be seen as a positive thing to kind of, because I know analysts were going to be talking on that, but still very, very good charts per se. Financial service products, this is up very much so because of SoFi Invest. Hopefully they do talk on the actual options activity today. So that could bring in a ton of money. But as far as lending products, it is still up, which is a very positive thing, but you don't get this massive kind of jump up what's been happening with the service products. So that could be seen that SoFi is trying to mitigate risk. That's how my interpretation, at least. And like I said, SoFi Invest up considerably from the quarter prior, or sorry, year prior. These are all year over year. And also I should add, as far as deposits, that is up very, very impressively. So I'm just going to take a look at the chat, pull this up. So it looks like we're kind of stuck around the 614, 15 range. And looking at the order book right here, it's because we do have that big couple orders right here on the ask front. But 73,000 shares is at $6.12. So we have, I think, ladies and gentlemen, that is our base for today. Hopefully we should be able to trend up periodically during the actual earnings. I'll be popping over here just so you guys can see relatively what is happening with the market and how they're interpreting the earnings. But based on the stats alone, it's looking very, very good. Like I said, the only thing they haven't really touched on is the kind of future guidance aspect of it, what they anticipate, whether it be options activity, or maybe they might be bringing whole new different additions to SoFi Invest or other assets that they have. What is going on, ladies and gentlemen? I'm surprised that a lot of you guys are still here. It's quite early. Like I said, this is one of the earliest live streams I've done. Eric, I have a feeling that a lot of people are going to feel the same mentality as you. I think this is going to be proving that this downtrend might be over for SoFi. Of course, there's a lot of external factors for the broader market, but I think when we... Actually, I just want to get a quick poll. Who of you that is watching right now bought in the $4 range? You guys are very lucky if you guys did. The only time I averaged down was at, I think, 505, somewhere around that. So I thought that $5 support, the third time round, was going to hold. Yeah, I got my ticket lost. Yeah. Raising new APY is going to be coming as well. I believe that is on the 5th they announced. And right here, just pulled it up. Okay, I'm sure a lot of you guys got this, but 3% APY. Sorry, I guess I was saying the 5th, so it is on the 3rd. So 3% as far as just on savings and vault balances, 2.5 on checking. And yeah, 62% of the national average. A lot of the traditional banks, as I said, don't need to incentivize any more customers. They have all of them, or at least what they can. I think this is why SoFi will be very interesting to transition when they transition away from incentivizing customers to come over to more so focusing on revenue. So SoFi has a pretty good situation happening, and it looks like we did break out of this small little downtrend. So 620s, and we do have our opposite contrary ask, so around 55,000 at $6.23. We'll see if we can break through that. Earnings does start in roughly about 2 minutes, so guys, just stay tuned for that. Exactly, Eric. Yeah, we're not going to the moon yet. You also have to factor in there's a lot of things that's coming out about the market. Like even tomorrow, per se, when they're talking about the rates, it's when Powell does give his little chat afterwards. That does usually calm the market, but once again, depending on what they say, that could just re-spark a lot of fear. But I think these earnings is a very good indication to us as investors that we at least have a very good diamond in the rough, I should say. Exactly, Christian. Macro events is still potentially what we need to watch for, but like I said, Q3 was very fearful during that time, and the fact that we brought in this amount of members, products, even more the lending products as well, I think all very much positive in the right direction. So 1 more minute, ladies and gentlemen, and once again, I'm going to be muting myself. Just listen to the Anthony and so forth. Afterwards, I'm going to go back on. We'll have a little powwow, a little chat about what is said, positives, negatives, if there is any, and then yeah. Oh, thanks, Eric. I appreciate that. as I always say, I like to give the good, the bad, and the ugly. Hashmat, with this earnings, and once again, depending on what they say, potentially maybe 675 is maybe a peak. I don't know. Given the market, we have enough to be sustaining there. Okay, it's starting right now.
Begin shortly.
Nope, never mind. Someone just came on saying it's going to start shortly. Yeah, some people, I think a lot of people are very optimistic about it going up, a lot of stocks going up generally. And I think SoFi is very undervalued. Even leading up to this amazing earnings, I still feel and realistically can straight up look at you guys and say, I feel we should be easily at $8. That's my honest opinion on basically what SoFi can offer. Because you have to factor in when what's encumbered within the stock price is several different things. Future revenue, technology, a lot of different kind of assets kind of all work in that. And SoFi's future revenue is just completely up. It just, like, even analysts, they're all forecasting it to basically double by 2025. But yet the stock price isn't really resembling that. So like I said, I think it's one of those things that's why a lot of people really get into SoFi, because it's one of the only undervalued banks out there, but yet it, as far as stats wise, it really blows a lot of them out of the water.
SoFi Q3 2022 earnings conference call. All lines will be muted during the presentation portion of the call, with an opportunity for question and answers at the end. At this time, I would now like to turn the conference over to our host, 𝗪𝗓𝗧𝗛 from SoFi Investor Relations. 𝗪𝗓𝗧, please proceed.
Thank you and good morning. Welcome to SoFi's third quarter 2022 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the Investor Relations section of our website. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantages and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our most recent Form 10-K, as filed with the Securities and Exchange Commission, as well as our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today, and we undertake no obligation to update these statements as a result of new information or future events. And now I'd like to turn the call over to Anthony.
Thank you, 𝗪𝗓𝗧, and good morning, everyone. Our third quarter results demonstrate the continued resilience of both our team and business and our ability to deliver another quarter of record revenue and EBITDA and strong overall operating results. A few key achievements from the third quarter include our sixth consecutive quarter of record adjusted net revenue of $419 million, up 51% year over year, reflecting record revenue in all three business segments. $44 million of record adjusted EBITDA, up 118% quarter over quarter. Continued strong performance in member and product additions, as well as cross-buy volume. Further scaling of SoFi Bank, with accelerating growth to surpass $5 billion in deposits, up 86% quarter over quarter, and savings of 125 basis points on cost of funds versus using other sources of debt to fund loans. Another quarter of positive GAAP net income for SoFi Bank at $28 million at an 11% margin. Members and products each saw rapid year-over-year growth with continued strong cross-buy trends. The 424,000 new members in Q3 2022 brings total members to 4.7 million, up 61% year over year. We also added 635,000 new products in Q3, ending with nearly 7.2 million total products, up 69% year over year. Of these new adds, financial services products of $5.9 million at quarter end grew by 83% year over year, while lending products of nearly $1.3 million were up 24%. The strength of our results once again underscores how our full suite of differentiated products and services provides the foundation for a uniquely diversified business that is able to endure through market cycles. Now I'd like to spend some time on segment level results with a particular focus on the benefits of a diversified business drivers as well as the structural advantage of our bank charter. In lending, our personal loan performance more than offset the continued lack of demand in student loan refinancing and the less robust performance of home loans. Student loan refi continues to be negatively impacted as federal borrowers await the end of the moratorium on federal student loan payments. Home loans face macro headwinds from rising rates while we continue the process of transitioning to new fulfillment partners. We originated a record of over $2.8 billion in personal loans in Q3, up 14% from $2.5 billion last quarter, and nearly double the $1.6 billion in Q3 2021. The product continues to deliver, and most importantly, this is while maintaining our strict credit standards and attracting borrowers with high incomes and FICO scores. While these origination levels themselves are impressive, the strength of our balance sheet and diversification of our funding sources provide new options to fund lending growth while driving efficiency with cost savings. These advantages are a direct result of SoFi Bank. Having more flexibility with our balance sheet allows us to generate more net interest margin revenue per loan and optimize returns, a critical advantage in light of the macro uncertainty. Additionally, by using our deposits to fund loans, we benefit from a lower cost of funding for loans and thus more profit per loan. In Q3 alone, the difference in our deposit cost of funds and other sources of debt was approximately 125 basis points versus 100 basis points in Q2, a powerful benefit in a rising rate environment. Lastly, we have a much more compelling value proposition in SoFi checking and savings as we can invest the greater revenue and profit per loan from the two benefits I just mentioned into an industry-leading APY, which drives direct deposit members, resulting in high-quality deposits and great levels of engagement. This has led to higher average account balances even as average spend has increased. We exited the quarter with over $5 billion in total deposits, and 85% of SoFi Money deposits are from direct deposit members. In fact, 50% of newly funded SoFi Money accounts are setting up direct deposit by day 30 versus 37% in the second quarter. And this has had a significant impact on spending. Q3 annualized spend was 2 times full year 2021 total spend, and Q3 spend per average funded account was up 22% quarter over quarter. SoFi Money members increased nearly 72% year over year to 2.3 million accounts while maintaining attractive demographics. In fact, the median FICO score for direct deposit accounts opened in the third quarter was 750. Given the quality of these members, we see ample opportunity for cross-buying in the future. Moving on to financial services more broadly, where net revenue nearly tripled year over year to $49 million and grew 61% from $30 million in Q2. We've continued to achieve strong member and product growth by iterating on products to ensure they are differentiated by 4 key factors: fast, selection, content, and convenience, and continue to invest to make them work better when used together. We finished Q3 with 5.9 million financial services products, up 83% year over year, and 4.6 times the total lending products of 1.3 million. The increased scale in financial services helps drive cross-buy and marketing efficiencies. Financial services sales and marketing spend as a percentage of net revenue was 58% in Q3 versus 81% the prior quarter and 105% in Q3 of last year. We achieved this improved efficiency even as we continue to scale our top of the funnel products, which often do not contribute standalone to revenue for 12 to 18 months. This is due to the increasing monetization and attractiveness of these products, growing brand awareness, and network effects. As mentioned, we continue to iterate and invest aggressively in our product suite, and that investment continues to pay dividends as members embrace our launches. Just in the third quarter, we introduced an increase in our checking and savings APY of up to 2.5% as of September 30th. In addition to the unmatched value proposition, a host of free features, and a unique rewards program. In fact, we're increasing our APY and savings to 3% this week to continue to drive more value for our members. Within SoFi Invest, we introduced new proprietary ETFs to the platform and remain on track to launch the much anticipated options trading product by year end, now in beta testing. We've increasingly utilized our Relay platform to acquire, educate, and advise our members on their holistic financial picture and their next best move. We launched credit alerts in Q3 and will continue to add features to drive engagement. The Relay platform has become a notable source of cross-buying, further bolstering the financial services productivity loop. We delivered unprecedented awareness growth as of Q3 2022 by delighting our target audience with compelling value propositions, reaching our target audience where they are effectively and efficiently, producing winning creative and leveraging data-driven tools to continue to get smarter. Transitioning to the technology platform, a critical element of SoFi's strategy. Not only is this segment a strong revenue and cash flow driver, but its two businesses, Galileo and Technisys, also contribute to two main tenets of SoFi's strategy: faster innovation at lower cost and high return diversified revenue streams. As a reminder, we're a consumer technology company that delivers financial services products. We need to be a one-stop shop for major financial decisions and all the days in between. To do this, we want to own end-to-end technologies, and that's where our technology platform comes into play. Only we can truly understand the technologies that we need the most. We build them in a way that's both great for us and for everyone else in the ecosystem. In the third quarter, full segment revenue of $85 million grew 69% year over year, which included another quarter of record revenue from Galileo with a 23% margin at the segment level, or 30% if you exclude Technisys. Galileo's overall diversified growth strategy includes growth in new verticals, new products, and new geographies. In Q3, Galileo signed 10 new clients and made big strides in its strategy, with a strong 30% of new deals in B2B and 40% of new deals outside the United States. Importantly, of these 10 new deals, 7 have existing subscribers, portfolios, or payment businesses, reflecting continued demand for our services and new use cases for embedded fintechs from more mature organizations. In Q3, we further invested in our push into the B2B segment by shipping 2 core capabilities. First, account-level controls, which provide self-service opportunities for program managers to set tighter controls in real time at the account level for where and how funds can be spent while reducing fraudulent transactions. And second, real-time funding, which automatically funds an account in real time during the transaction process, optimizing the working capital needs of our SMB customers. I'll finish here by saying that we've been in an all-out sprint over the last 5 years to build out our digital product suite to meet our members' needs for every major financial decision in their lives and all the days in between. The benefits of our strategy to build a uniquely diversified business, combined with a national bank charter, not only positions SoFi to be the winner takes most in the sector transition of financial services to digital, but also provide greater durability through a market cycle. I'm excited about where we are today and even more excited about where we can go from here. With that, let me turn it over to Chris to review the financials for the quarter.
Thanks, Anthony, and good morning, everyone. Overall, we had a great quarter with strong growth trends across the entire business. We achieved record revenue and record EBITDA. I'm going to walk you through some key financial highlights for the quarter and then share some color on our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the third quarter of 2022 versus third quarter of 2021. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next week. For the quarter, growth accelerated and we delivered record adjusted net revenue of $419 million, up 51% year over year and 18% sequentially from the prior quarter's record of $356 million. Adjusted EBITDA and margins improved year over year as we delivered a record $44 million at an 11% margin, representing 3x year-over-year growth on a dollar basis and nearly 700 basis points of year-over-year margin expansion. Sequentially, EBITDA was up $24 million and margins expanded nearly 500 basis points as we saw margin improvement across each of sales and marketing, technology and product development, G&A, and ops functional expense lines. Now on to the segment level performance, where we saw strong growth and record revenue across all three segments. In lending, third quarter adjusted net revenue grew 38% year-over-year to $297 million. Results were driven by 93% growth in net interest income and 10% growth in non-interest income. Growth in net interest income was driven by a 70% year-over-year increase in average interest earning assets and a 144 basis point year-over-year increase in average yields, resulting in an average net interest margin of 5.85% for the quarter. This represents 126 basis points of year-over-year and 62 basis points of sequential NIM expansion. Growth in non-interest income was a result of increased originations and strong personal loan and student loan sales execution. Q3 originations grew 2% year-over-year to $3.5 billion and were driven by record volumes in our personal loans business, which grew 71% year-over-year to $2.8 billion. However, both student loan and home loan originations were down by more than 50% year-over-year as we await the expiration of the moratorium on federal student loan payments coming in January, while rising rates and fulfillment issues continue to impact our home loans business. We achieved this top-line growth while maintaining our stringent credit standards and discipline focused on quality. Our personal loan borrowers' weighted average income is $160,000 with a weighted average FICO score of 746. Our student loan borrowers' weighted average income is $170,000 with a weighted average FICO of 771. This focus on quality has led to strong credit performance. Our on-balance sheet delinquency rates and charge-off rates remain healthy and are still below pre-COVID levels. Our on-balance sheet 90-day personal loan delinquency rate was 30 basis points in Q3 2022, while our annualized personal loan charge-off rate was 1.95%. Our on-balance sheet 90-day student loan delinquency rate was 11 basis points in Q3 2022, while our annualized student loan charge-off rate was 0.33%. As we've expressed in the past, it is reasonable to expect credit metrics to revert over time to more normalized pre-pandemic levels, but continue to expect very healthy performance relative to broader industry levels. The lending business delivered $181 million of contribution profit at a 61% margin, up from $118 million a year ago and a 55% margin. This improvement was driven by a mix shift to higher margin personal loans revenue, as well as ops efficiencies and fixed cost leverage across the entire segment. Shifting to our tech platform, where we delivered record net revenue of $85 million in the quarter, up 69% year-over-year, while record Galileo revenue was up 29% year-over-year. Overall, annual revenue growth was driven by 40% year-over-year Galileo account growth to 124 million in total, as well as sequential growth in transactions per active account. The segment delivered a contribution profit of $20 million, representing a 23% margin and 30% if you were to exclude Technisys. Moving on to financial services, where net revenue of $49 million increased 288% year-over-year, with new all-time high revenue for SoFi Money and continued strong contributions from SoFi Credit Card, SoFi Invest, and Lending as a Service. Overall monetization continues to improve, with annualized revenue per product increasing for the second consecutive quarter to $34, up 112% year-over-year from $16 in the same prior year quarter, and up 46% sequentially from $23. We reached 5.9 million financial services products in the quarter, which is up 83% year-over-year, and we continued to see strong product adds, with 557,000 new products in the segment. We hit 2 million products in SoFi Money, 2.1 million in SoFi Invest, and 1.6 million in Relay. Contribution losses were $53 million in the quarter, which increased year over year predominantly as a result of building our CECL reserves for the SoFi credit card business, which is expected as we continue to grow and scale. In addition, we saw a year-over-year reduction in higher margin digital assets revenue. Switching to our balance sheet, where we remain very well capitalized with ample cash and excess liquidity. The recent opening of SoFi Bank further reinforces our strong balance sheet and provides us with more flexibility and access to a lower cost of capital relative to alternative sources of funding. In Q3, assets grew by $3 billion as a result of adding loans to the balance sheet, given the strong growth we continue to see in personal loan originations. On the liability side of the balance sheet, we saw tremendous growth in deposits as they grew to $5.0 billion, up $2.3 billion quarter over quarter. Because of this, we exited the quarter with $2.5 billion drawn on our $7.1 billion of warehouse capacity, which represents 35% of our total available capacity. Let me finish up with guidance. Throughout the last 12 months, we have demonstrated the benefit of having a diversified set of revenue streams and a keen focus on underwriting high-quality credit. We expect those benefits to persist going forward, even in light of the existing macro backdrop. Our outlook also assumes a late Q4 2022 benefit in student loan originations ahead of the January 2023 federal student loan payment moratorium expiration based on the trend that we experienced in 2021. This benefit is expected to partially offset seasonal Q4 softness we typically see in other lending products. For the full year of 2022, we now expect to deliver revenue of $1.517 to $1.522 billion, above our prior guidance of $1.508 to $1.513 billion, and full year 2022 EBITDA of $115 to $120 million, above our prior guidance of $104 to $109 million. Overall, we couldn't be more proud of our Q3 results and continued progress. Having delivered nearly $1.7 billion of annualized revenue and over $170 million of annualized EBITDA, we continued to make great progress against our long-term growth objectives in the quarter and remain very well capitalized to continue pursuing our ultimate goal of making SoFi a top financial institution. With that, let's begin the Q&A.
Thank you, Chris. Before we open up the lines for Q&A, I'll ask those in the queue to please limit yourself to just one question. Thank you for your cooperation, and with that, the operator will now open up the line for questions. Operator, please go ahead.
Thank you. As a reminder, if you'd like to ask a question, that's star one on your telephone keypad. If you'd like to withdraw your question, you may press star two. Please ensure you're unmuted locally when asking your question. Our first question for today comes from Eugene Simuni from MoffettNathanson. Eugene, your line is now open.
Thank you. Good morning, guys. Great results. Congratulations. I'll start by asking about the growth in members. Very strong quarter again, over 400,000 added. Can you talk a little bit about what customer acquisition channels you're finding most successful, where these members coming from, and how sustainable do you see this growth trajectory in the members?
I would say there wasn't a meaningful change in the different channels that drove member growth. We're really happy with the trend that we're seeing in member growth. And I would say the quality of our members is increasing as well, and the data that we have from our members is increasing as well, which gives us more opportunities to help our members get their money right. What I'd say is, we're really trying to target high quality members with good compounding growth over years, not over any one quarter. So we're targeting 400,000 net new member adds per quarter. At some point that could take a step function up, but right now we're sort of balancing the growth from a member base with quality, as well as making sure that we're building our technology and processes to meet our members' needs as we scale so meaningfully. The bank strategy has been a huge help to us. It's allowed us to not just drive member growth in SoFi Money and SoFi Checking and Savings, which lowers our cost of funding, but it also allows us to be more nimble in other areas like our Relay product, and we can experiment much more with the Relay product and having people connect their credit card accounts or their checking and savings accounts or their brokerage accounts and put in the real estate. And that information can then help us cross-sell into the checking and savings account, which is really attractive. We didn't have that same leverage point in the past, and so the combination of those two is also something that's new.
Thank you. Our next question comes from 𝗪𝗓𝗧 Bhatia from Bank of America Merrill Lynch. 𝗪𝗓𝗧, your line is now open.
Good morning. Thank you for taking my questions. I wanted to start with the student loan changes. Obviously, a fair amount of changes with the Biden administration passing, their student loan, or not passing, but announcing and then trying to implement their student loan plan. In addition to the loan forgiveness, of course, changes to income-based repayment levels too. And I was just wondering, what is SoFi's view on the plan overall? And just can you discuss maybe some of the key points of the plan that will impact your business and the actions you are taking? Thank you.
Thank you for your question. We've been clear that we support targeted forgiveness programs, and the announced programs that the administration released are aligned with what we thought would be a fair and balanced targeted view on programs. We think the most important thing for people that have federal student loans is clarity and consistency. And so we encourage the administration to stay on track and to provide transparency and clarity on execution so they can make the best decisions on how they want to get their money right. We think that addressable market for student loan refinancing is quite large, even with these changes. Many of the forgiveness programs will probably not be applicable to our member base and our target demographics. The income levels below for qualification, our income is higher than the income level you have to be below, and a number of other factors that would cause the TAM to be still large. Now, that TAM can increase and decrease depending on where federal funds rates are and overall WAC is for that product in the marketplace, but the number of people that will still have federal student loans outstanding that could refinance is really, really large still.
Thank you. Our next question comes from Dan Dolev from Mizuho. Dan, your line is now open.
One second. Hey guys, outstanding results. Great job, guys. Quick question, Anthony and Chris, can you give us a sense of like the CAC trends that you've seen over this quarter and the last 2 quarters? Thank you.
Yeah, sure. Hey, Dan, thanks. So what I would say is we've made really good progress in overall marketing efficiencies over the last few years, and that's been driven by growth in brand awareness, cross-buy, and scaling our lower CAC products. If you were to look at Q3 22, you'll see that our sales and marketing as a percentage of revenue decreased 400 basis points year over year and 200 basis points quarter over quarter. In terms of specific CAC trends, I would say that we're acquiring members today at a level that supports our longer-term EBITDA margin target of 30%. When determining how much we're willing to spend to acquire a member on a day-to-day basis, we're looking at a host of different factors. We're looking at the lifetime value that member could achieve, and we're also looking at overall payback periods. What we've observed recently over the course of the last few quarters is that our overall LTV of financial services members has increased as a result of having the bank and focus on growing direct deposit members. And our payback periods are in the 12 to 18-month time frame. That's done is it's given us additional flexibility on CAC and the ability to scale the number of financial services products that we have. This growth and investment in financial services products has resulted in CAC efficiencies within our lending products. And you'll see in the Q that our overall CAC for new lending members decreased by 8 to 9%, both year over year and sequentially. And that's really helped contribute to the overall margin compression that we're seeing.
The other thing I would just add to what Chris mentioned is something that we learned in the lending business, and then something that I think applies now that we have one-stop shop with all the other products. Sometimes it's misleading when a company drives low CAC. It has been the case that within lending, if we drive CAC too low, we lower the quality of the borrower that we bring in, and the life of loan losses of the portfolio can actually go up, which would more than offset the CAC savings. And so it's counterintuitive to think about CAC and financial services. What we focus on is what's the right CAC within a unit economic standpoint, whether that's a per account economics or that's per loan economics, to drive an acceptable variable profit. So when we multiply that variable profit per account or per member by the number of people that have that product, that total variable profit dollars exceed our fixed cost and drive to our long-term 30% margin. So there will definitely be ups and downs in CAC based on mix shift, based on environments, but no, we're solving for the LTV equation and the right unit economics to drive to a 30% margin. And it's not always the case that a lower CAC is good. You could have much lower quality members and money in checking account, for example. Our direct deposit growth has been really strong. I'd pay a lot more money for a direct deposit customer than I would for just a funded customer because of all the benefits we get in debit interchange in addition to lower cost of funding on the loan side.
Thank you. Our next question comes from Moshe Orenbuch from Credit Suisse. Your line is now open. Please go ahead.
Maybe on mute.
Sorry, can you hear me now?
Yes.
Hello? Can you? Yeah.
Yes.
Sorry about that. Maybe this will be a little bit of a follow-up from the previous questions. The SoFi Money accounts that you added, you pointed out, were more kind of direct deposit and more likely to be richer. Any sense as to whether this is at least in part a function of kind of a pullback from kind of PE or venture capital funded other neobanks, and also again following up from those last answers, is there a way to dimension whether it's CAC or profitability in terms of how you think about that benefit over the longer term, just given that they're more likely to purchase lots of products and in particular lending?
Yeah, we had really strong metrics in checking and savings and really high quality. 50% of our newly funded SoFi Money accounts are setting up direct deposit by day 30. That's up versus 37% in the second quarter. And if you benchmark that versus other companies, that's a really high percentage. The quality of those members from a credit standpoint is also very attractive. The median FICO score for direct deposit accounts opened in the third quarter was 750. That's a direct result of us architecting the product to meet the needs of our target member. We're going after high earners not well served. They have average income of over $100,000 per household. They have 680 FICO scores and higher. That doesn't mean we won't serve other people that are outside of that core demographic, that target. There are concentric circles around that will benefit from these products. But we architected it specifically to attract that type of member. That combined with great targeted marketing and iteration over the last 3 years has resulted in really strong quality as well as still maintaining pretty good growth. The other thing which doesn't get talked about too much because it's just scaling so significantly is the amount of spending that's happening on the platform. If you annualize our Q3 spend number to 4 quarters instead of 1 quarter, it's over 2x what we did in 2021. So a really substantial increase. And on a per account basis, we're up about 22% quarter over quarter in spending. So the strategy is really working, and the bank license has allowed that to come to fruition, and we're really happy with the outcome.
Thank you. Our next question comes from Michael Perito from Stifel. Michael, your line is now open.
Hey, good morning. Thanks for taking my question. I wanted to look ahead to next year a little bit, but not kind of financially, just strategically. I mean, obviously a lot of the year-on-year improvement has really stemmed from the strong bank-related growth, the impressive direct deposit growth, the credit card debit interchange, the lending, and on the personal loan side and the growing balance sheet. I'm just curious, obviously you guys have to balance kind of the bottom line profitability and the balance sheet growth, but as you look ahead to next year, I mean, what's your appetite to continue to grow the bank balance sheet and drive higher NII? Just curious how you guys are kind of strategically thinking about that. That would be great. Thank you.
Thank you, and Chris and I will tag team. I would say holistically, I'm really looking forward to having a year in which we have continuity and stability across markets and across company-specific initiatives. If I reflect back in the last 5 years, every year we've had a major company-driven initiative or a economic backdrop or market backdrop that's been somewhat volatile. Obviously, we've been dealing with the student loan moratorium for the last 3 years. Add on top of that going public, add on top of that switching to becoming a bank. We just haven't had a year in which all of our businesses have the wind at their back. And that is possible in 2023. And I am very aware of the current outlook for the economic environment and inflation and interest rates. But if things sort of hit where consensus is, we're going to have a year in which all things could have a really strong tailwind. As I think about our growth versus investing, we're going to stick to what we've talked about in the past, barring any unforeseen acquisitions or major strategic initiatives that were unplanned, with what we call the 70-30 plan. We're going to reinvest 70% of incremental revenue in the business and drop 30% of the incremental revenue to the bottom line to show progress towards our long-term margin of 30+% on an EBITDA basis. And so the growth that we have this year is one that we want to compound for decades, not for just 1 year, and have it be consistent over time. So we will continue to reinvest in the business with that ratio. And we think we're at such early days in all of our products. The only thing that's gating our growth is driving awareness. And there's a lot of ways to drive awareness. One way is obviously paid marketing. Another way is virality of your products and partnerships, and we'll continue to lever all three of those opportunities. But we've barely scratched the surface on how big we can be. And, now there are over 4.5 million members. We have our sights on, high single digits and double digits after that, and very aggressive perspective on what the cross-buy opportunity will be for us. So we will invest meaningfully, but against that ratio. And if the economic environment is worse than expected, then we'll adjust accordingly and make sure we can deliver that ratio.
Our next question comes from John Hecht of Jefferies. John, your line is now open.
Thanks very much, guys, and congratulations on a good quarter. Chris, I'm wondering, can you maybe characterize or break down a little bit the gain on sale? Just, lots of interest in hedging versus the kind of executed gains, and also maybe characterize just general investor interest in the different products given the changing environment.
Yeah, sure. Hey, John. So in terms of our gain on sale margins for the quarter, our personal loans business was at 3.25% excluding hedge gains. And it was 4% when you include hedges associated with loans sold in period. Student loan refinancing was 4.3% excluding the hedge, and it was the same on a hedged basis given that all loans sold in period were in a fixed rate structure. And then our home loans gain on sale was negative 1.7% excluding the hedge, and 90 basis points including the hedges. What I would say in terms of overall appetite for our loans, things continue to be robust. We ended up selling over $1 billion of loans in the quarter. Like I said, given the fact that we have the bank today, we have sufficiently more flexibility than we had prior to that. We have sufficient excess liquidity. We just raised $3.6 billion of equity last year. We have a large and growing deposit base of north of $5 billion now, and we have $7.1 billion of warehouse capacity available to us, only 35% of which is drawn. So we have a ton of flexibility with respect to being able to hold loans on the balance sheet for a longer period of time, and we're going to seek to maximize ROE on every single loan that we underwrite in a given period of time.
And one additional thing that I'd add, just at the kind of first principle standpoint, we've been fortunate in that we have the technology, data, and process systems to test iteratively each week, different price points and different credits. And so we've been able to effectively increase the weighted average coupon of our loans as Fed funds rate have increased, which gives us a benefit on the execution and the value of those loans. And at the same time, being able to reduce our cost of funding. The combination of those two with, strong life of loan losses within our target range allows us to get to great value on a per loan basis that we're trying to drive maximum variable profit dollars within a certain ROE.
Yeah, and just building on that to put it in more context, you'll see in the queue next week that the weighted average interest rate earned on our entire PL personal loans portfolio increased 60 basis points quarter over quarter for the second quarter in a row. And that 60 basis point increase is on the entire portfolio, not just new in-period originations that occurred. So if you look at just new period originations, the actual quarter over quarter increase in WAC was substantially more.
Which is just a phenomenal job by our team to maintain the profitability of our loans and still drive the growth that you're seeing at unprecedented levels in that product.
Our next question comes from Kevin Barker of Piper Sandler. Kevin, your line is now open.
Great. Thanks for taking my question. Just to follow up on some of those comments around the gain on sale and everything. It looks like you originated about $2.8 billion of personal loans this quarter, and the growth on balance sheet was a similar amount. Is there some strategy whereby you're holding all these loans, or there's certain loans that are remaining on the balance sheet for an extended period of time? I know you talked about it earlier this year where you would hold them for average would push out. But is there something going on with the personal loan originations that would cause you to hold them on the balance sheet, maybe have the sales occur mostly in the fourth quarter?
Yeah, so what I would say is our strategy hasn't changed. Given the flexibility that we now have with the bank, we're able to hold loans for a longer period of time, and that was certainly something that we did in Q3 as well as Q2. What I would say is having the bank provides us with sufficiently additional flexibility and a new source of funding, which allows us to grow that balance sheet and hold loans for a longer period of time. There are a few ways that we can grow loans on the balance sheet and generate net interest income. We can either originate, which has been the primary source of driving volume in terms of personal loans, but we can also repurchase loans. In addition to that, one of the things that we've done with a number of our whole loan forward flow agreements is structure them in a way where we have the right of first refusal to purchase loans when the buyer wants to sell. And we're starting to see more and more of that where from time to time we see a whole loan buyer come to us with a first refusal to purchase loans. And given the credit quality and loss profile and return of the loans that we originally underwrite, we strongly consider that. So that's something we'll also take into consideration.
Our next question comes from Dominick Gabriele from Oppenheimer. Dominic, your line is now open.
Excellent. Great results on revenue and EBITDA. I just wanted to ask, versus a lot of the other fintechs that have recently come to market, you've really been obtaining high quality FICO customers versus lower tiers. And one of the very large banks recently talked about new entrants typically having to, gain traction in the lowest tiers first. But that just doesn't seem to be the case for you guys. And your strategy seems to be working. So maybe on a product level, how are you beating the competitors and the incumbents to obtain these higher FICO score customers versus the low end? It'd be great to hear. Thanks so much.
You're welcome. I'd say it's old school, focusing on the fundamentals: product, pricing, promotion, placement. The 4 Ps. If you go back to 2018, when we first changed the leadership of the company, one of our priorities was focused on quality over quantity. And it was a really tough decision. We took our volume down meaningfully from where it was in 2017. In addition to that, we took it down relative to what the prior team thought they would be able to achieve. And the reason was we wanted to re-architect the product so that on a per loan basis, we could achieve through the cycle a 40 to 50% variable profit margin. And I won't walk through the equation of how to get there, but we're happy to do that offline if it's helpful. Well, we looked at that variable profit margin by channel, by marketing channel, and we developed a much more sophisticated approach to pricing. You only could price 50% of the loans at one price and 50% at another price, and we developed a whole construct to be able to do 36 cells across 6 different grids, so to speak, and it's gone way, way beyond that now. And so it's really hard to find people that don't necessarily need to refinance. It's really easy to find people that need to refinance. In addition, when you do find those people that may not necessarily need to refinance, you have to give them a cost savings or benefit relative to their other choices. So it needs to be compelling. So you have to find them. The price that you're giving them or the savings you're giving them has to be of greater value than what they're currently doing. And then you need to make sure you have the right operational controls, the right life of loan losses and credit processes to ensure that you underwrite appropriately with the right operating and CAC costs. The last thing I'd mention is, our credit models continue to be updated based on property data, which helps us now more than before. We're trying to underwrite to free cash flow. And so the more information we have on your income, the more information we have on your spending, the better we can underwrite to free discretionary free cash flow. So it's a combination of all those different things. And the last thing I'd mention is, our time to fund a personal loan is 2 days. It used to be 8 days. Our time to fund a student loan used to be in the mid to high teens. Now it's in the single digits. That's also a factor that people underestimate in terms of the ability to meet the demands of that borrower when you do find them. In addition to that, we have a sense of urgency. We don't rush. We want to make sure we underwrite appropriately, but we have to be competitive using our technology and our operation to deliver a short time to fund.
Our next question comes from 𝗖𝗢𝗡𝗘𝗖𝗧 from Citigroup. Ashwin, your line is now open.
Thank you. Anthony, Chris, good quarter. Congratulations. I want to talk about the technology platform. If you can go through in sort of more granular fashion about the investments you're making in the platform and the client take-up of cloud banking. And then the sequential growth in Galileo accounts has decelerated the last few quarters. Is there any ongoing implementation or other efforts to re-accelerate that? Thanks.
Sure. Thank you for the question. So on the technology platform, we're really pleased with the growth that we're driving, and even more so with the processes that have been undertaken to provide a stable, reliable, and resilient platform for our partners, and the pipeline of products that we've built in addition to the integration of Technisys and Galileo. The major investment that we've made over the last 2 years of owning Galileo was transitioning from on-prem to into the cloud. And that transition is largely done. I think the report I've seen most recently is 99% of our authorizations are now in the cloud. And that's really going to provide great SLA performance for our partners and allow them to innovate faster and be more nimble using data real time to make better decisions. We have a robust pipeline within Galileo for our partners, but we also have a robust pipeline for new verticals. So we are definitely starting to migrate away from just pure B2C. We talked about the B2B customers that we've been able to attract the last couple of quarters, and the pipeline there remains very robust. And generally, the B2B companies already have existing payment systems and payment supply for us to process. So when we convert those over, there will be a faster time to revenue and also be a much higher probability. In addition to building products for B2B that are more controllable for them and meet their needs better, in addition to just having the processing capability, we're also continuing to expand internationally with really strong trends throughout Latin America, both on the back of Galileo as well as Technisys, which was where it was strong to begin with. In addition to geographic expansion, we have a robust pipeline of products for our existing partners. We'll be launching Pay in 4 in the coming months. Pay in 4 is a product that was built on Galileo and on Technisys. It'll be the first product that's built across both processing and the core technology. And that will be a great product for that large installed base of 120 plus million accounts, many of which are B2C. And it's one that better suits the demands and the interest of the lower income customers of our partners on the B2C side there. In terms of growth in the future, I would say we're not planning for accelerating growth, but the TAM is so large and we've made such large investments, that is a possibility on a revenue standpoint, as well as on a revenue per account standpoint. It's not something that we would forecast, but it's given it's so early in the transition of physical payments to digital, and we're so early in the new launch of many of our products that it's possible, but it's not something that we would forecast. In terms of demand, we're focused much more on existing portfolios than we are on startups because of the known value that's there and the hugely differentiated service that we have in the cloud and being end-to-end with core technology plus processing plus the front end. We are a much better solution than what's currently out in the marketplace for many financial institutions that are very scaled. And so those have longer lead times, but they'll have bigger paybacks and much bigger impact to the absolute dollars that we generate in revenue.
Our next question comes from Michael Ng from Goldman Sachs. Michael, your line is now open.
Hey, good morning. Thank you very much for the question. I was just wondering if you could talk a little bit more about deposits. You know, it's encouraging to see the progress there. It seems like the deposit inflows have accelerated pretty meaningfully from the $100 million per week that you talked about earlier this year. You know, against the backdrop of the upcoming increase, you know, what are your expectations for the deposit inflows run rate? And separately, are you seeing any changes or headwinds in deposit inflows from consumers investing directly into money markets or treasuries? Thank you very much.
You know, we've definitely been winning share of deposits. We think we have an incredibly differentiated checking savings account with high interest on checking of 2.5%, no fees, free overdraft protection. You can spend with your phone, spend with your card. You can do person-to-person payments. You can do bill pay, free roundups, and a unique rewards program. So I think our product is unmatched when it comes to checking across those different dimensions. Not to mention you'll become a SoFi member and get a number of other benefits. We also introduced SoFi Plus, which is a way to pull together all of the different benefits you would get as a member, in addition to a few incremental pieces of value on rewards step-ups. And that is a product that gets unlocked through direct deposit. And while it's very small and early from an awareness standpoint, it's actually delivering the type of impact that we thought it would drive. So we're winning deposit share. I'll tell you, we're taking it from the traditional banks. Someone asked the question earlier, and I forgot to answer, you know, what are we seeing from the neobanks that are maybe focused on the underserved or neobanks more broadly? Are they pulling back on marketing and not seeing strong growth? I'd say what we see in the industry is they're seeing great growth and we're seeing great growth. And I think they're serving the underserved incredibly well, that were unbanked as well as underserved by traditional banks. But the vast majority of what we're seeing is coming from the largest banks in the United States, and we're winning deposit share from them. We do watch the deposit trends more broadly in the industry, and it's clear that not only are the large banks losing deposits to digital companies like SoFi and fintech companies like SoFi, but they're also losing it to money market funds. But we want to have an attractive rate that competes against all of the different options they have, including investment accounts and money market funds.
Our next question comes from Jeff Adelson from Morgan Stanley. Jeff, your line is now open.
Good morning. Thanks for taking my questions. Chris, just wanted to follow up on the loan growth question from earlier and maybe just hone in a little bit on the outlook from here. I know you mentioned some of those drivers, including the bank flexibility, repurchases, et cetera. But in terms of the kind of doubling of the loan hold period you've talked about from 3 to 6 months, is that now effectively in the run rate? And should we more or less be thinking about the loan growth from here as kind of matching the % growth in originations? Or is this something where you think you can continue to add loans at the same clip as your origination dollars? For instance, you know, you added about $3 billion of sequential loan growth this quarter, which was, you know, roughly in line with your personal loan originations. And then just as a quick follow-up, wondering if you guys can give us an update on your Q-to-date October deposit growth. Thanks.
Yeah, so I'll let Chris answer the question more numerically. I'll just share a perspective. The great thing about the financial services sector is that the factors for growth change constantly. Interest rates are changing. The economic environment is changing. The financial markets are changing. And I would tell you, being here 5 years, every quarter presents a different set of outcomes across all those market factors than we thought at the beginning of the quarter. And we run to where the opportunity is. And in some quarters, that opportunity may be driven by being able to raise WAC. In some quarters, that opportunity may be driven by a really strong securitization market. In some quarters, it may be driven by a really strong wholesale market. The most important thing is that we diversify our funding sources and we diversify our distribution as well as our ability to hold. And that gives us an ability to be nimble when conditions change to go after those opportunities. And so I don't want anyone to think that it's a straight line, linear in any fashion. It's never been a straight line or linear in every fashion. Every quarter has presented different opportunities that we can take advantage of. The thing that has resulted from having a one-stop consumer-focused strategy is that we have these diversified businesses so that we can go in one direction or the other when things change. And the thing that I have found that gates our growth more than anything else isn't the market conditions. It's actually our ability to keep driving awareness and keep driving trial of our products and becoming a household brand name that's trusted. We could grow much faster if we spent more on marketing. It would be very profitable over the long term, but it'd be less profitable in the near term. But the gating factor for us is how much do we want to drive awareness and trial. As it relates to your specific question about what this means in terms of loan growth on the balance sheet, I'll let Chris answer.
Yeah, so in terms of whether we're benefiting fully from the 6 to 7 month hold period at this point, I'll take you back to when we opened the bank. We started originating all of our SLR, PL, and home loans in about the March, April timeframe, and we weren't fully originating until May. And at that point, it would take 6 to 7 months to really fully realize and get the benefit of the extended hold period. So we certainly saw a material uplift in net interest income in this quarter in Q3, but we're still not going to see the full realized benefit of that 6 to 7 month hold until Q4 in the November timeframe. So really good progress, but the full benefit will likely hit in Q4. And on your other question on deposit growth into October, we aren't disclosing that.
And the only other thing I'd add on deposit growth is that we did announce yesterday that we're moving the savings rate to 3% on APY, and we'll continue to be nimble in the marketplace and ensure that we're in the top tier of value that we're adding to make sure we continue to get these high quality deposits. The FICO score that I mentioned earlier and the conversion of open accounts to DDs is really strong, and we would love to be more aggressive there, but we want to make sure we can maintain the quality.
Thank you. Our final question for today comes from David Chiaverini from Wedbush. David, your line is now open.
Hi, thanks for taking the question. Could you discuss the dynamics around the net interest margin and the outlook for the next few quarters? You just mentioned about how the savings product APY is going up 50 basis points to 3%, and you mentioned earlier about loan pricing being up 60 basis points in the quarter, but could you kind of net those out for an outlook over the next few quarters?
Yeah, so we aren't providing specific guidance on our net interest margin, but what I would say is we've had really good success over the course of the last several quarters in terms of raising our overall yield, and that's a function of a mix shift towards more personal loans and a success in being able to raise our weighted average coupon 60 basis points across the entire portfolio for the last 2 quarters. In addition to that, our deposit betas have been roughly 50%. So when we're going to see natural NIM expansion there. What I would say in terms of the go forward, there will be a number of things that will impact the overall NIM margin, and most predominantly, it will be our ability to keep pace with rising rates, which we expect to be able to do on the personal loans product. But it'll also have it'll also be impacted by the mix shift of student loans and home loans on the balance sheet. As we continue and expect a rebound in demand from student loan refinancing, those loans have a lower yield or weighted average coupon, which would have an impact on net interest margin. But overall, we're happy and proud of our ability to expand NIM and expect to be able to maintain these levels.
Thanks, Chris. And before we wrap, I wanted to share some final thoughts. As we enter the last quarter of 2022, I would be remiss if I didn't take a moment and thank our entire SoFi team that has just been incredibly resilient in our ability to execute through volatile times to deliver a 6th quarter of record revenue and record EBITDA this quarter of $44 million. The results you see today are a direct result of our people and our people's ability to meet the needs of our members. I can't help but be incredibly optimistic about the future of SoFi, given the unprecedented results of the last 2 years and the resilience our team has shown. Even in the toughest market conditions, quarter after quarter, we've delivered on our goals, exceeding expectations across the board. It's an absolute privilege to lead this company as we help change people's lives every single day for the better. Our members need us more than ever, and we'll continue to show up for them in spades. There is no shortage of challenges ahead, but there has been no shortage of challenges every year since I joined nearly 5 years ago in 2018. And with each set of unique challenges, we've continued to rise to the occasion. And ultimately, we'll work tirelessly to be prepared as best we can for whatever we face ahead, just as we have each year before. Until we talk next quarter, thank you for your interest and thank you for your support as our shareholders.
Thank you for joining today's call. You may now disconnect.
Okay, well, that was very, very good. So let me know your thoughts in the chat, what your initial takeaways are. So I made some notes. So 86% of all the deposits came from direct deposit. And I think that's one kind of takeaway that I really stressed that was very positive that came out from the Q2. So 86%, that goes to show is like it encompasses SoFi's all-in-one plan. SoFi is doing pretty much what it says. So a lot of good takeaways from today. I think it was 9 analysts that gave ratings. Q1 there was 7, Q2 there was 7. So we're getting more interest clearly, and that should translate to more analyst ratings. Again, very positive for the underlying business, and lately they've been giving us $7-8 price targets. Might be a little bit higher possibly. I do have the ticker going up as well, so clearly up 18.01% right now. High FICO scores. So FICO scores, once again, for borrowers, average is 771 as far as FICO score. So that is like crazy high. So when it comes down to SoFi mitigating risk, and as I said at the very beginning, so a lot of analysts were going to probably try and tear SoFi apart as far as what are they doing to mitigate risk in the future. Anthony and Chris have done a phenomenal job. They did very, very good. But they did stress the point that high quality customers, and they kept saying that. So for the borrowers, so customers that do borrow, their average income is $170,000. So SoFi is doing something good there. 771 for FICO score. The average general customer for SoFi earns $160,000 and has a FICO score of 746. And then as far as brand new customers, it's 750 is the average. That's over the last 30 days. Launch options activity. It is going to be done this year. They are currently undergoing it in beta testing. So that is very profitable. That I believe it was up 46%. The SoFi Bank, if I remember correctly. No, SoFi 72% from the previous year over year or quarter over quarter. And when we have options activity, that's going to blow everything out of the water. So when you think that SoFi Invest makes a lot of money in that aspect, this is nothing. Like once we get options activity, that's why a lot of people really focus on that, is because it's a big deal. One thing as well I found interesting is that SoFi is trying to accommodate customers. And so they've mentioned something. It was just brief, but they said that their time to actually allocate for personal loans and for home loans and so forth is 2 days. So that means it takes them 2 days to fund and give someone money. So they're really trying to accommodate for on that customer aspect, whereas previously they said it was 8 days. So they're really trying to accommodate to customers, and even he said, Anthony said that they're taking money and market share from the big traditional banks. So it's good to see. Keep in mind when they're talking about that, they're more so talking about Citibank and Bank of America. Those are more so the kind of similar banks to that. They do oddly though anticipate, didn't really elaborate, but he said that they do anticipate higher student loan benefits in Q4 to offset the historical softness in lending in Q4. So that might be something for us just to refer back to in Q4, that potentially the lending might be a little bit less, but supposedly to offset that, they're going to be getting a lot more revenue coming from students. So again, that is a win-win, I think. Let's see. Yeah, they honestly, I agree with you guys. I don't think they could have done much better. Yeah. And I liked Anthony's, I guess to finally cap it off, I like Anthony's last touch when he said about I never heard of the word CAC, but I guess CAC represents, I guess, the cost for customer, maybe. Clearly that's what it meant, but he said that an analyst said, why not lower to try and bring in just, I guess, equivalently low quality customers? And Anthony answered saying, well, we found that it's not advantageous to do so. So they are above the market and the sector average to bring in and continue to bring in that quality customers. So I think it all cycles back, like I said at the very beginning before any of this started, it is customers. It all boils down to customers. Like, customers are the X factor in the banking sector, and we are getting them, and we are getting very, very good, high quality ones, and very rich, if you want to just say that blatantly. But yeah, no, I'm excited, and yeah, it's good to be over my average. So luckily I did take advantage of 625 as an average, so I'm happy. But still, no matter what, like, even before SoFi and I got in because of it being a chartered bank and so forth. I averaged down several times. But outside of that, I invested very heavily in my overall position largest is banks. So I'm a big fan of the banking sector, if you want to call it that. I know what it can do, what drives it. And I think this is why I'm very much passionate about SoFi, because it meets my kind of components as far as investing, if that makes sense. I think one thing that could come maybe tail into 2023, 2024, because hopefully, given the same nature of where they're going, they could be potentially fully debt-free by maybe Q1 2024. Of course, any bank, it's not really advantageous to be debt-free. They're always going to try and spark something. Anthony did say, though, that there's been a lot of clearly big acquisitions, being a chartered bank, and there's always been a big transition or big substance in every single year, that a lot of them can't just take a step back and let things go. In other words, that's how he said it. He did say 2023 might be that year. So hopefully there won't be any big acquisitions or big dilution or whatever it is in 2023. So very positive for us as investors to think about it in that format. Exactly, Simon. Yep. Quality over quantity. I think that's the new 2022 term, and I think should be the nice transition. And so I think today is a very best case scenario for SoFi. A lot of banks or just general, a lot of companies come out with good earnings, good news on very red bad days, which just gets killed. It gets brushed underneath the rug. But broader market is very much green today. Market clearly really much liking the SoFi earnings. It is a win-win. Let's see. Yeah, Hake. I think a lot of people early on were very hesitant, or I guess if you want to take a step back, when it got to here, there was a huge amount of capital that was still continuously getting into the market. So I think a lot of these numbers, I tend to agree with you. With the current earnings that they've had, I think this is now the fifth very good earnings back to back. Third, I think, or fourth. But yeah, we should definitely be significantly higher. And as I've kind of touched on, I bring this up on occasion, just on a couple of videos, just to put it in perspective on how undervalued SoFi is. And a lot of people seem to not really realize. So like I said, Bank of America is one very similar one. There's also Citibank. And just for argument's sake, I'll throw in JP Morgan. Just on this front, over the last 6 months, SoFi is clearly lagging down roughly about 14%, whereas a lot of the other banks, so JP Morgan up 10%, Bank of America up 1%. So typically, a lot of these growth stocks, when there is a sign of a rebound, they do go up a little bit more aggressively. So that's something to factor in. And just to pull that in perspective, as far as on a 1 year comparison, SoFi is down 76% on a 1 year basis. Although, keep in mind, 1 year prior to here, they weren't a chartered bank, so I don't know if it's fair to compare them at that stage, but yep, exactly, Shimar. SoFi is going to be something big. We all know that. At least I like to hope that we all know it, but the price hopefully should reinvigorate a lot of people. Of course, most likely in the first market, you are going to see a little bit more of a pullback. A lot of people taking profits that probably got in at 5 is up 25%. That's what they're happy with. But we should be, as far as today, range bound between the 610 and, in reality, I'd say 650, maybe a little bit higher, 675. Shorts as well, just to give you a quick update. I was giving you some updates during the live stream. They're increasing pretty flat though, 23,000, 24,000 shares. So not much going on in that regard. So today's a very good day. Okay, let's see. Okay, let's go in the presentation. I think so you were asking about, I think you initially said adjusted 𝗖𝗓𝗧. So it looks like Q3 44,298 to 44 mil. Let's see. So that's a pretty big jump from Q2 was 20, and then Q1 was 8. But I guess Q1 doesn't really necessarily count in a lot of cases. But yeah, exciting time. Hopefully that answered my price prediction. So I guess as soon as you start talking about price predictions outside of hypothetically, I don't know, let's say 2024, I think there's going to be another pullback. Because when it comes down to a recession, and I'm talking about a big recession, usually there's several different things that could prompt that. One of which is more so on a corporate standpoint, the other being a consumer standpoint. A lot of people are hypothetically, when they're talking about a recession this time around, is linked to consumers because of higher interest rates, inflation, things like that. But as of right now, all the data, for the most part, there's been some cracks and shows signs of weakness, but consumers are still technically doing fairly well, out there making money. That doesn't always last forever. Of course, there will be a pullback, but by 2025, I would honestly put SoFi around, in reality, maybe around the $30 range at that stage. And that's if it does continue the same growth, and more so as well. I do anticipate probably in 2024, possibly maybe Q1 or tail end of 2023, them start to transition lower, not kind of increasing the APY as much as they have been, and more rotate towards revenue and you capitalizing on that, because a lot of the traditional banks offer basically nothing for APY, but on the opposite end, they have the customers, so they don't need to offer or incentivize people to come over. SoFi will get to that stage. Mark my words, though, that is when this will blow up. So it might be stagnant around, probably around maybe $14 range for a while. But once we do hit that rotation out, then that will just be a massive game changer. No, Terry, 818, pretty good, pretty good. I think I just checked 806, something like that. Yeah. I will pull up SoFi. So our technicals as of right now, yeah, we're in a kind of an interesting scenario. So momentum number of retail investors are definitely getting in very much today. Stochastic, funny enough though, we are at 70. So similar to what happened actually when we went down, we were very kind of oversold for the longest time. Now, stochastic does show it as a little bit more overbought, but it does have that deviation starting to occur, which is a black line above the red. So again, that is showing a underlying bullish sentiment. We are very much outside the Bollinger Band, and usually 9 times out of 10, it kind of will cause a pullback. So this is where potentially, like I said, around the $6.10 range, we could have a little bit more of a pullback because of that. But we're above basically a lot of the good pivotal moving averages. So above that 50-day moving average, which as you can tell right here, we've attempted numerous times, failed to successfully stay over. So the fact that we're over that shows that, and kind of rotating into a pivot for bullishness. We do have that 200-day moving average at $7.56. So that might be our next target. So we might be range bound in reality between that 100 and 200-day moving average. So basically $6 to $7.50, depending on the momentum that is happening behind the scenes and the broader market. But no matter what, it's going to be the Feds tomorrow. The Feds tomorrow, depending on all of that, it's hard to say. And actually, I did do a poll on YouTube as well, just to kind of see what people are thinking. And I believe the majority of you feel that 75 basis points is coming. So if it is, I personally feel that's already factored into the price. But on the opposite end, though, it all comes down to Powell. He can sometimes say, you know what, we're humoring the rest, because you have to factor in PCE numbers recently came out last Friday, and that's what the Feds use to dictate interest rates if they're going to be doing that. CPI is a little bit more heavy weighted on energy, so a lot of people like to talk about that, but CPI is very flawed in a lot of cases. But the Feds might keep the 75 basis points and probably just say we're going to continue to monitor the market, not going to do any potential interest rate hikes in the coming future. That would give the market a nice massive rally based on that. Eduardo, negative 9 cents. Estimate was 10 cents. So that's a beat. So we beat on earnings per share, revenue, and in reality, future guidance. So we got a triple home run here. And technically, I guess this is the fourth massive triple beat on as far as earnings. Very, very exciting, guys. Market opens in roughly about 13 minutes, give or take. Yeah, I agree with that, Adam. 50 basis points would give us a very big rally. Mitch, that's a pretty good position. Yep. One good thing that we could also technically all help SoFi in is if we all get SoFi loans for investing purposes, and that way you can write off any residual interest. So it's basically free money, and you're also helping your investment. A lot of people don't think of things like that, and when you invest in a bank, this is how a lot of people could potentially help. Not a financial advisor though, but yeah, Eduardo, 1,000 shares is still very good. Yeah, SoFi has everything that it does that a traditional bank has. Obviously, just on a smaller scale. Just probably a little bit better of stats in reality. But like I said, X factor, I think some takeaways, like I said, from the earnings. Customer growth up very much, 61%, and that is that big thing. Even if you don't care about any other factor, customer growth is what SoFi is trying to encumber, and 86% of all of these deposits were done and contributed by direct deposits. So this is that's very, very impressive. So we have the customers. We clearly have them all in how do I say this? I don't know. Just they're all with us, doing every aspect of our business. We're getting student loans, personal loans, home loans, every front of that we're all getting. And credit cards, another home run quarter for that. One thing as well, I guess more so on a criticism that I didn't hear at least, is they didn't touch on cryptocurrency. Just keep in mind they recently launched cryptocurrency, I believe it was last quarter, and I would have figured they would have at least touched on that and said it's successful, it's not, whatever it is. They didn't really say that, but again, whatever. One small thing they didn't mention, it's not that big of a deal. But yeah, very, very happy about the overall results for the quarter. So don't forget to hit that thumbs up and subscribe. Always greatly appreciated in all of that aspects. Stay tuned for a lot of fun videos coming up. And you guys have a good rest of the day. Thanks for coming out this early morning with me. But thanks, guys. And you guys have a good rest of the day. See you guys. Oh, and actually, to answer your question, Eric, as far as auto loan, I don't anticipate them getting into that right yet. Unless they just encumber that within the personal loan aspect. But direct having for auto, I don't think so. But you guys have a good night or a good day. Yeah, I'm wrong about the day.